Welcome to TheoTrade. This is Don Kaufman. August 9th, 2017, doing the Theo Night video. First and foremost, markets today are just incredibly resilient. If you miss some of the overnight and after hours trade from yesterday, so the S&P futures traded all the way down to 24.59 throughout the course of today's live trading session. You're looking at that on the screen right now. When I talk about resilience, well, the S&P futures picked back up. They're only down 3 right now with about 13 minutes to go to the close. The reason I mention the resilience is if you're looking from a tick-by-tick standpoint, and this is ticks, right? I explained this a lot in some of the recent sessions we've done. For the most part, whether you're looking at the S&P 500, whether you're looking at the Russell 2000, the New York Stock Exchange, or the Nasdaq, what these red hash marks indicate are literally down ticks. That means if you looked at the S&P 500, there's 500 stocks. In each minute, there are more down ticks than upticks out there, and it's prototypical of sell side activity. So again, to speak of resilience in the marketplace, here we have a situation that in the next few minutes, the S&Ps could actually be positive on the day. But let's not just stop there. And one of the themes I really want to drive home in tonight's video is, yes, the S&Ps are almost unchanged. Okay, here's a bit of a change in tone, if you will, in markets. The volatility futures were incredibly reactive today. Yeah, they're only up about 30 cents right now, but we have seen no movement whatsoever recently in terms of the volatility futures. So then you look a little bit deeper on your screen, but volatility futures, well, for the most part, they're just confirming, they're kind of indicative of what's going on in the S&P futures right here, right now. You look a little further down the screen, you start to look at the VIX, you're like, I mean, really? Okay, there was, major threats of geopolitical risk, war talk yesterday. That's it. I mean, you're looking at the VIX at 11.65, and it's almost staggering to think that. So I then look down and I start to recognize, I'm like, oh, wait a second. The bonds are reacting. The bonds took off to the upside a bit today. They're up almost a full point. For those of you that do not read bonds, 32 ticks is a 1-point move. So the bonds were a bit reactive. But with the bonds being up, and what the bonds being up, really, what is that a signal of? It's typically big time capital. And what they do is they're buying bonds as a protective stance. So, you guys hear these phrases kind of like, risk on, risk off. And, when risk is coming off, and that's off of equity markets, okay? When risk is off of equity markets, they're typically buying into bond markets. So this morning in early trade, like if you were looking at it, when I say to early trade, to this point in the day, early this morning, you're like, whoa, these markets are about to get hammered. And that's when I speak of kind of resilience in the marketplace. But even with the bonds right now that are up, prior to this close over here, the bonds are up some 29 ticks. I look at the XLF. They're almost not only unimpeded, they're going to close up on the trading day. So I've mentioned time and again, you've got to watch the XLF. The XLF in the last few days has moved down, but specifically yesterday, and that was our primary theme yesterday here in the evening video, big time key reversal inside of the XLF. With the XLF over here gets bid back up after gapping substantially lower. Now, it's not out of the woods just yet. Again, it looks like the XLF is going to close up today. If you're into trends over here, the trend might still possibly be down. Nevertheless, the S&P futures look like they're going to end up on the day. So what does all of this ultimately amount to? Like, you're throwing risk at the marketplace. You're throwing, global geopolitical threats at the marketplace. It still doesn't sell off. So I look further down on the screen, and I mentioned this a bit in yesterday's evening video, and I'm going to elaborate a bit upon it today. The VVIX. So for those of you, if you've never looked at the VVIX, it's the volatility of the volatility index. Basically what the VVIX denotes, and the VVIX is screaming right now at the 110 level, okay? And I provided yesterday some really definitive levels. Basically, when the VVIX gets above 100, it catches our attention. When the VVIX gets to like the 105 region, it's starting to be like, I'm dangerous. at 110, that's get under your desk and, put your helmet on, we're going in. And one thing that it really grabs me today, the VVIX out of the gate was bid up, and for the most part is still bid up. They haven't backed that VVIX down at all. So you're like, okay, so what exactly does that mean? The VVIX is measuring, okay, if you will, it's measuring the volatility activity in the VIX itself. It's saying that the VIX itself is going to be extraordinarily volatile. I mean, in the end, what does it really amount to? To get the VVIX to the 110 region, there has to be huge buyers, okay, of VIX options. So I went in here early on in the trading session today and I took a look. The total volume that's trading in the VIX today, it's close to 1.7 million contracts. That is about 2.6 times the norm. Now that's the norm versus the previous 5 trading days, all right? So that's 5 trading days over there. So the norm being 1, it's trading, 2.64, that 5-day kind of average. 1.7 million contracts, though, is a hefty size trade. When you compare it to the fact that, the SPX, and the SPX, again, the granddaddy of all the products out there, the thing's almost a $2,500 product, but even the SPX, its volume is not, anything catastrophic. There's nothing huge going on there. It explains right now what you're seeing is the VIX is not moving. Right? Why is the VIX not moving? Because there's no real activity. Like the SPX is not getting crazy, but the VIX options clearly are getting crazy. And I looked a little bit further into this. I mean, you start looking at things like volume and open interest, okay? What it tells me by looking at this, I'm just 41 days out, okay? What it tells me, look at the activity in here. It's huge, huge by huge. And you realize that, well, some of these could be closing trades. Look, here's 45,000 contracts that traded 200,000 open. Yeah? Well, here's what? Almost 85,000 contracts. There's only 32,000 open. Most of these look like opening positions. The one, okay, truth about this, they're buyers. How do we know that they're buyers of those calls? How do you know that? Okay? You know that because the volatility shot through the roof. Demand is the only thing that shoots volatility up. Okay, what this ultimately points to at this time, and what it really means in the larger sense, you as a retail client need to be extremely defensive, okay, in the next couple of days, next few weeks over here. Why? Well, specifically because they're going out and they're very quietly in the backdrop buying every piece of volatility that is not nailed down. That's what drives the VVIX to 110. Now, mark my words. After the VVIX hits 110, it doesn't matter at that point what it does tomorrow. Like if the VVIX comes all the way crashing back down to 94, like, oh, okay, it's okay. Everybody go home, just call off, it's all canceled. Listen, even if it goes down, it doesn't matter. All of these traders still have, okay, that kind of crash protection, if you will, in place. That's what they're doing out there. Now, they're not out there buying volatility in the volatility index, okay, per se, because they're trying to take a shot that the market's going to crash, right? Or that the market's going to sell off big. And I'll be very, very concise about this. Nothing in any of these says that the market's going to crash. What they're doing predominantly is hedging. You as a retail client, you don't necessarily need to hedge. Why do you not need to hedge? Ultimately, because your risk is small enough that you could just take it off. But if you're a fund with $7 billion, okay, in markets, you can't exactly just take that risk off, you start heading for the door with $7 billion, people are going to kind of figure that out. So what they do is they come out here and they buy, okay, extraordinary numbers of calls in the VIX. And they're like, well, they'll worry about the 50 cents later. Right now, they're just worried about covering their butts for the next 41 days. Okay, but again, even if the VVIX drops off, it's not okay. All right, the VVIX, and I'll explain this a little bit more depth by bringing up a 3-year. Okay, if you go back a ways over here, again, this is back into 2014. I was showing you this. This is like what I call the Ebola trade. But one of the points that I want to make with this, all right, if I zoom into this particular time frame, this is in, and again, look it up for yourself. It is in December of 2015. So in December of 2015, the VVIX spikes. There was a little bit of sell side activity going on in markets right at this time, a little bit. But the primary sell-off ensued in this time frame. Yeah, sure, the VIX did pop back above its head, back above 110, but for the most part, the VVIX, okay, kind of reared its ugly head well before there was sell-side activity. And that's something that we've seen time and again. If you start to actually look at the VVIX and kind of scroll forward, you're like, what was that blip on the radar screen over here? Okay. I mean, this is when we start going through things like, you know, Brexit. Then what do we have over here? We ultimately have what? The election. All right. Prior to the election, yeah, people saw risk coming, but they didn't see it. Okay. And they didn't jump on it the day before the election. They're looking at risk, what? Couple of weeks prior to and leading up until the election, and then it took a couple of days for the volatility to ultimately recede thereafter. Again, but that's a planned event, an event that we knew. It's a binary event. Right now, we are up there, and you really need to consider, okay, that we've cracked into this range. Look for risk to kind of rear its head. Again, markets were incredibly resilient today. For those of you that are trading on an intraday basis, I don't think you have to worry as much about this. But for those of you that carry more substantial positions, okay, listen, this is not, you know, me making a bearish argument right now. This is me explaining what order flow is ultimately relinquishing to you. And right now, order flow is relinquishing that it's extremely dangerous. There is no other explanation, okay, for the volatility being bid that hard, that fast. The only explanation is that, again, okay, large firms see a tremendous amount of risk right here on the forefront. It could be days out, it could be hours out, it could be even a couple of weeks out. As you saw, they're out there and they're buying that, you know, volatility, but they're out there about 41 days out. Again, the VVIX measures the volatility approximately on an average of 30 days out, but the options they're using are approximately 41 days out in time. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.